baby, are you looking for some high-yielding, dividend, cash-flowing real estate investment trust? Do I got one to diversify your portfolio today? And you are literally going to be owning hospitals, which in a pandemic couldn't ask for better than that. And of course, if you're OG, I'd be talking about that medical property trust. My goodness, guys, this sucker's trading down a whopping 18%. I recently just bought it before earnings, and I'd be getting crushed. But considering it's paying a 5.68% starting yield, that's really not too bad. But from where I currently sit, guys, I'm down almost 7%. I picked up 436 shares. My average buy, $21.13 a share. But that cash flow it's going to be producing for me sits at around $488 annually. Keep in mind, this isn't like a monthly paying REIT. It is quarterly, but we're talking about hospitals here, folks. Now, keep in mind, I'm a Canadian buying it over the border. I'm going to lose about 15% of that income. So I'll be making maybe like $415 annually. But on the Canadian side of the border, you're talking almost $500, right? So pretty happy with that on the conversion side of it. And considering they've compounded the dividend growth over the last just under 10 years from 20 cents to 28 cents. It looks like they're on track to grow the dividend every 10 years by about 50%. So you're buying it today, a 5.6% yield. That continues into the future. You can expect in the next decade to be getting about maybe closer to an 8% yield, which is pretty incredible overall. But let's take a look at these books. These books, what are we paying for this sucker? Well, at a $19 billion valuation based off those last earnings that came out, minusing those total liabilities of about $10.8 billion, their underlying asset value sits just above about $8 billion. Not that bad overall here, folks. And if you take a look compared to the market cap of $11.6 billion, we're paying a few billion over the underlying asset value. But this company's been doing a phantasmal job growing, which we're going to talk about in a recent article that came out. But let's keep moving forward here, folks. If we scroll down just to make sure they can afford the dividend, which is a little farther down the way here on the adjusted funds from operation on the last quarter, the 3-month end, they made about 34 cents. And because their dividend is paid quarterly at 28 cents, they do have room to pay that. Because keep in mind, every smartass out there just goes into Yahoo Finance. They scroll on over to statistics and they're like, it's paying at 140% payout ratio. How are they affording the dividend yield? Well, that's because they do write-downs, damn it. A lot of write-downs. But let's talk about some of the bleak news, the not so good news. And it looks good because they're growing total revenue like there's no tomorrow. Incredible stuff. The stock is trading down toward its pre-pandemic levels here, which doesn't make any sense because they're going to be generating like a couple $100 million more in revenue. They're expecting to do about $1.4 billion this year, which isn't bad considering in 2020 they did about $1.2 billion. But keep in mind, a lot of this growth is coming from share dilution. We can see that they are diluting us as shareholders. But let's talk about the company itself. I mean, what the heck? What are hospitals? What are hospitals, right? I mean, they're hospitals. What more could you say? There's not a lot to explain. You don't need to worry about tenant reliability. The company's portfolio, their largest tenant makes up no more than 3%. Their lease terms largely go out past 2030. They have inflation rates baked into the rental prices. So every year they can increase the rent based on inflation rates, which also comes to a conclusion of dividend increases. And just taking a little deeper look here, folks, again, 22.3 billion total portfolio, 446 facilities, globally diversified, might I add, which is some absolutely wonderful stuff. And I mean, you can take a look at this yourself, but how hard is it to explain hospitals, right? The total return of this company is relatively entertaining to me because depending on the time period, there is some indifferences here because since inception, it's up 555%. I'm curious if that includes share buybacks or not. However, on a 3-year term, they're outperforming the S&P 500. I somehow would like to see a more related or updated calculation here because something tells me that's not true. On a 5-year basis, they're underperforming slightly. On a 10-year basis, they're underperforming slightly by about 50%. But again, why are you buying this? Why are you buying it? I always recommend having a nice portfolio of growth stocks, but when you're looking for that cash flow to reinvest, if you're using that money to just directly buy new stocks, and let's say you buy growth stocks with the dividend, there's a likelihood this company could help you outperform the market a lot quicker if you're redivesting those dividends. But why am I talking about this REIT today? Well, they recently just had an article come out, and this company has been acquiring. Though they've been diluting us as shareholders, they're constantly reinvesting that capital where it matters the most. And based off this article, they're claiming that this Alabama REIT pays $171 million for borrowed hospital and medical office buildings. This was actually actually a recent acquisition, and they're claiming that an affiliate tied to the Birmingham-based Medical Properties Trust paid $171 million for 459-bed hospital property, 3 office buildings, and a medical office mall near the Florida Turnpike in Lauderdale Lakes. And Lauderdale, I think, is close to Ben Malla, the big real estate mogul guy. But just scrolling down, this is pretty incredible because it includes 138,000 square feet of medical office space. So bringing this into a rounded conversation here, folks, I know I'm fairly excited about something that isn't growing at something like a Google's pace, but when we're looking for cash flow to retire, you see this chart back here, that red line represents my dividend growth, and I'm always focusing on companies that not only can pay cash flow today, but grow those dividends in the most sustainable manner possible. And I'm willing to give up a slight bit of growth because I know I'm going to be reinvesting those dividends for some short-term stability and getting that cash flow. And honestly, I've made some mistakes. I used to buy things like GEO Group and some of these prison REITs, but let's put that aside and focus on something that is going to be more poised thanks to what the pandemic just did. And I think these hospitals are going to be in a big demand. Surgeries coming back. People feel more comfortable to get themselves checked out. And again, hospitals, guys, what better tenants are you going to be asking for? So in a diversified real estate portfolio, I got some Canadian REITs. I got some stag industrials focused on like clients like Amazon. And then this beauty just puts that cherry on top of the cake. And right now is probably the ideal time to be buying it. Not when I was buying it, I paid 21 bucks a share. However, you're going to be getting a $19 discount if this kind of company intrigues you. Stay cool, stay awesome, and I'll catch you tomorrow.